In this video, we're going to look at three of the more popular tools for measuring performance. The first is referred to as Jensen's alpha. So alpha measures the portfolio's performance against expectations. Positive alpha indicates skill in choosing securities or good timing. If you subtract the expected return from the actual return, you get the alpha. So the expected return here is based on the capital asset pricing model. Here is our formula. Refer to this as the security market line. We have the risk-free rate. We have the rate of return on the stock market. And of course, beta measures the risk of the stock relative to the stock market. So structured this way, the equation reflects a linear equation. So the values of alpha and beta can be found several different ways. We could use a linear regression statistical model, and that uses the Standard & Poor's 500 for the market return and the realized returns of the portfolio for the actual rate of return of the investment. So this linear regression can also find alpha and beta using Excel. So here is an example. We have 60 months of a stock. I don't know what stock this is, but it's the stock return minus the risk-free rate of return. And we compare that to the S&P 500 return minus the T-bill rate. And this provides us the theoretical excess returns that we're interested in. So now it's not looking for the alpha isn't the risk-free return. Alpha is the measure of our ability to create value for the company. So you can see here are our Excel formulas. It's equals intercept, and then you put the column of the stock, and then you put the column of the market. That will give you alpha. And the beta we see here is equals slope for those same two columns of numbers. And the statistical analysis, the linear regression analysis provides down here, says alpha is negative 0.002, and up here you see it is 0.23%. So those numbers are essentially the same. 1.168 versus 1.17. Of course, they're giving us the same data. So it's probably a little easier to deal with the Excel formulas. However, we are interested, if we're doing statistics, we would be interested in the value, the statistical significance. Now, if you look at the p-value here, it's kind of hard to see, but the p-value for alpha is 0.62, and for beta, it's 3.85, but it has 16 zeros before the decimal point. So essentially, the probability, the statistical significance of beta is 100%, right? That's the number, 1.17. But the this 0.002 number, it is not statistically significant. So what does that mean? It's not statistically different than 0. However, we do have a number, right? It is, in this case, it is negative. So again, let's put this into some other real-life situations. We have 4 portfolios or 4 assets, and then we have a portfolio that is equally distributed across those 4. Here are the betas, and here's what the capital asset pricing model says we should earn if we bought this investment. So again, the returns of those that have been earned. Cap M is what you expect or what you want to earn. We have our Standard & Poor's 500, 9.3, risk-free is 2.5%. So now if alpha is positive, it means it performs better than CAPM. If alpha is negative, it means it's worse. Now, how can that be? That outcome can be due to a couple of things. It could be due to security selection, or it could be due to market timing. So in this case, if we look, we see that asset A has a negative alpha. And negative means it's performing less than what we expected with CAPM. C has the highest alpha. From this analysis, we would say that C is performing better than the other assets. It is the best performing of the assets. Or C is overperforming the other assets, and A actually is underperforming because it's negative. The second tool we can look at is something called the trainer index. Again, we start with the excess returns. You take the return of the investment minus the risk-free return, and you divide it by beta. So this, again, just measures how the excess return, how we perform relative to the systematic risk of the company. So this is a risk-adjusted number. Right? It measures the excess return earned for each unit of systematic risk. So let's see how this works with our portfolios. Again, we've already calculated CAPM. We have that. Now we need to calculate the trainer index. So for asset A, this would be 7.5 minus 2.5 divided by 0.8. So that gives us here a trainer index of 6.25. And again, the higher the number, the better the performance. Since all of these assets have positive returns greater than the risk-free rate, they will all have positive trainer indexes. In this case, we see that C still has the higher value. So higher Jensen alphas are typically associated with higher trainer index values. Jensen alpha shows excess returns. Trainer index is used to compare portfolios. The Sharpe ratio shows the risk premium relative to total risk. Very similar to the trainer index, except now our denominator is standard deviation rather than beta. How can we find standard deviation? We can get that from historical data, and sometimes it is actually published. Morningstar publishes this data for mutual funds. So if the Sharpe ratio is less than 0, it has poor performance. It is performing. The only way it can be negative is if the rate of return is less than the risk-free rate. Again, larger, though, is still better than smaller. So here in our Sharpe index, we see that things have changed. The Sharpe ratio is a measure that's utilized the most. It measures excess return relative to standard deviation. It uses the total risk of the asset. So it's probably less valuable as a tool for stocks than for portfolios, since portfolios tend to have less diversifiable risk. But what we find here is that asset A, again, all of these are positive because all of the returns are in excess of the risk-free rate. So they're all earning something above the excess, right? They have positive excess returns. But relative to the total risk, we see that asset A is the highest performing of these portfolios. So let's think about just some basic concept. If we're measuring variability, we're looking within the asset's returns and an average. So we're kind of looking at historical kinds of information. Volatility, though, compares one period's return to some outside measure. So if I were measuring the changes in returns compared to the changes in the stock market, that would be volatility. But if I was looking at my company's standard deviation measures my historical returns. So Sharpe's ratio considers variability, but it does not assume any diversification. Jensen's alpha and Trainer index use volatility. They assume diversification. One other aspect that we need to be concerned about is just when the data doesn't give us real good numbers, right? When it gives us things that should concern us. So when returns are positive, Sharpe ratios are very easily interpreted, right? Higher Sharpe ratio means better investment. But what if it's negative, right? If A here has the higher return, right? -8 is higher than -10, but because of that, it also has less risk. Because of that, it has a lower Sharpe ratio. It's -4 compared to -1. So when we're looking at negative Sharpe ratios, we really do need to be concerned and take that into account. Maybe we want to look at some other ratios, maybe the Trainer index or the Jensen alpha in those instances, just to help us understand the relative positions of these investments and their performance. Look forward to seeing you in the next video.